Okay, folks, welcome back. This is our midweek review for the ICT mentorship for May 6th, 2020. All right, so here's the economic calendar. I believe, if I'm not mistaken, I did not include it on the weekend review, so I apologize for that, but you all know how to find it anyway. This is what's on tap for the remainder of the week. So tomorrow we have pretty heavy list of events. Bank of England monetary policy report. Let's start with this. Tonight, Australian dollar, trade balance, high impact, and high impact inflation expectations for the New Zealand dollar at 11 o'clock. And then tomorrow, during the London Open, GBP has a slew of events. Monetary policy report, official bank rate votes, monetary policy summary, and official bank rate. Then 8:30 tomorrow, New York session, we have unemployment claims, high impact for the dollar. I expect that number again to be above their forecast, and high impact for euro at 10 o'clock in the morning, ECB president speaking, and 9:30 p.m. tomorrow again, high impact monetary policy statement. And on Friday, New York session, high impact euro, president speaking from the ECB, and 8:30 a.m. high impact for Canadian dollar employment change and unemployment rate, and hourly earnings for the U.S. and non-farm payroll and unemployment rate for the U.S. for a typical non-farm payroll Friday. All right, so let's go over to the charts and take a look at what's going on. Okay, here's the dollar index. This is our daily chart. And you can see we did get down below the short-term low here, and we were anticipating the potential for it to roll lower into the sell side liquidity pool. The dollar did not do that at all. It rejected the low here, traded back inside of the range, back above the bullish order block, and that becomes a discount array again for the range between this high and this low. We'll look at that when we get down to the lower time frame, but I want to talk a little bit about the price action theory that leads to, if we have an expectation, or as I illustrate every single week on Wednesday and on the weekends, I give you my opinion about what may transpire in price action. Now, when it's right, obviously it's fun, but when it doesn't pan out, and I give you some of the things that would negate the idea or the bias, that's crucial for your development, because you have to have a parameter to delineate where the analysis is no longer valid, and does it warrant an opposing view or an opposing trade idea, or does it just mean simply move to the sidelines? So before I get into this, just remember that this is typically our week where we don't do a lot of trading post Wednesday New York Open, because it's non-farm payroll, and you saw the economic calendar coming for Thursday and Friday. So it's scattered with landmines, and there's really no way of knowing with a great deal of certainty how the central banks are going to reprice based on those economic drivers. But put that aside, okay, and say it's a normal week. Say it's a week where we don't have non-farm payroll, and it would be a week where we'd expect a Monday through Friday typical weekly range, and not the standard practice of only looking for Monday to Wednesday's New York Open for a setup the week of non-farm payroll. So if you're new in your notes, we always make a mention of this the first week of every month that has non-farm payroll. The impact of that report and leading up to it now more than ever, because of the historic levels of unemployment, it's gathering momentum in the U.S. And I guess it's not just in the U.S., it's around the world too. But nonetheless, that driver, okay, or that volatility injection that usually is seen with non-farm payroll Fridays, they have now more reason to build in sentiment ahead of that number. And generally, and this is for your notes also, the price action that leads up to non-farm payroll generally is, in my opinion, a Judas swing. So am I saying that all of this rally here is fake and then maybe we'll roll lower? That potentially could happen. What I'm watching is how we trade above this volume imbalance right in here. If we trade above this and we come back down into it as support, acting kind of like a bullish order block would occur, then I would expect it to run the buy side liquidity here. It needs to trade convincingly above this. Now, some of you say, well, if it's going to go here, what difference does it make if it's going to, trade up to here? It's pretty obvious at that point. No, not necessarily. It's not necessarily that obvious, because we are in a range-bound environment and they're building sentiment. And May is a month where we really start to see heavy seasonal influences come into the marketplace. They're heavily weighted in the commodity markets. It's heavily weighted in the interest rate market. All of those factors are going to have a direct impact on the price delivery of the dollar index. So what I'll be watching to see is if we get into this tonight, the volume imbalance here, just look at the closing price at 100.29 and an opening price on this candle at 132. Well, no, I'm sorry, 123. Okay, so 29 and 23. Okay, so 100.29 to 100.23. That's a volume imbalance. Okay, so again, if you're new, what's a volume imbalance? Just write that in your journal, and the answers are given to you in the content. But the unwillingness to continuously go lower after running this low here and not grab this liquidity, I was expecting it to do it very easily, like it was primed to go lower, but they jammed it all the way up from Monday, Tuesday, Wednesday, and it would not be surprising to see them tank this late Thursday into Friday's trading. Again, what changes the narrative and my expectation is how we trade above, if at all, this volume balance. Okay, so in other words, it would need to trade above it, then come back down into it as support, and then I would look for it to trade higher for the buy side liquidity. And this topic will continue, or in this lesson, if you will continue when we get to cable. But for now, let's drop down into an hourly chart on Dixie. Okay, so here's the hourly chart on the dollar index. You can see we traded down here on the first and then brought new trading in on the new week here. Didn't come down to close any of the gap. I thought that was kind of interesting and just kept pushing it higher. I like the fact that we have these relative equal highs here. They could just as well go up into this level here. Notice what they're doing here. So the next expectation would be to see it ramp through here and trade through that. Now, if it gets exceedingly bullish, we have a small fair value gap right in here. This, to me, is less likely, but I'm going to include it just for the sake of completeness. There you go. But we're watching the stops that resides right here. All right, and that'll be the business for the hourly chart. But it's just creating a nice little trend line. You know my thoughts about that. So if it ramps above, runs the stops, then look for the break in the phantom trend line that easy as buying a diagonal support line or shorting a diagonal trend line when you're bearish. To me, it's just it's just too inviting for that type of thing to be valid. And then we could see it potentially trade all the way down, and then the goal would be by Friday to close up the gap. Okay, that's what I would look for, if not the very minimum, run below these equal lows. It's not a thing to go out there and start trading because it's non-farm payroll. I do not trade on Thursdays and Fridays ahead of non-farm payroll. I don't do it. So if I'm telling you I don't do it, why would you want to do it? Well, maybe to be different, I guess. Well, different doesn't always equate to being smart. Sometimes you got to get corrected, and the market will absolutely sort you, and you don't want to go through that kind of pain to learn a lesson. Okay, just take the word of advice. Don't do it. Paper trade it, demo trade if you feel like you want to, but it's better for you to exercise discipline and not do it at all, and only look at what it's done from a spectator standpoint, not a participator. And let's go into the 15-minute time frame for dollar. Okay, you can see a real nice fair value gap with bullish order block, and we trade down into it running sell side liquidity. Pops up in here. I like the idea they keep these equal highs here, as I outlined on the hourly chart just a moment ago. That's what we're looking for, it to run into that. And then does it reject that and go lower and then make an attempt to get down below this low and this low and this low, which is all kinds of sell side liquidity resting right below that 99.30 level. So next to 99.30 are institutional 99.20 level, which is just outside of the view of this video. There we are. So 99.20. So do we run up into the 125 to 29 level, just above the 100.23 level, get inside of that imbalance, the volume imbalance from the daily chart, and then drive lower to get down to the institutional level 99. All right, so here's the euro dollar. It's our daily chart, and we'll look at this when we get down to the lower time frame. We did run the short-term high in here on the euro dollar, but we have since traded lower and just fell short of reaching back down into this old low here. So do we need to touch that again, or do we rally with weakness in the dollar? It remains to be seen. We'll see what happens from there, but really nice run on buy side liquidity here, and cleared up some of this relative equal lows, which we'll see in a lower time frame. Just for completeness sake, I'm going to throw in this, put a blue line on here, and I'm annotating the opening price of the last down close candle, which is our bullish order block, and you'll see how we also go below that. But this is the order block that we're trading into. We did not breach that low yet. It could, and that's fine. I'm not saying it can or can't. Right now I'm in an observation mode. I'm not trying to engage. I'm not trying to participate. We typically want to dial back our expectations and our participation in the week that has non-farm payroll. Okay, so I can't stress it enough, because there's a lot of new people in here, and I know you're going to want to email me questions. What about non-farm payroll? Why is it this and why is it that? Just look at the economic calendar that in the past and see when the previous non-farm payroll reports were coming out, and you'll hear me start those weeks up in the weekend with commentary saying, remember, this is non-farm payroll week. We don't do anything after Wednesday's New York Open. So if we have trades open, we can manage them, but a great deal of position needs to be squared away, taken off the table in terms of risk, tighten up our stops, and just see what happens, but expect to get stopped out, because it's very uncertain. Thursday and Friday just gets sometimes really stupid in terms of its price delivery. It can be very frustrating, and to avoid all that, just let them have that few days of every single calendar month. It's not a big deal, and it's not necessary for you to be participating, just because sometimes it creates a big move. Yeah, sometimes it does, and sometimes it doesn't. But just about all the time, it does what you don't expect it to do. And it becomes a 50-50 crapshoot. And I don't like gambling. I don't like having low odds like that. So we avoid it. We can study it and see if there's any signatures after it happens and delivers. But other than that, it's a rather moot point to me. Okay, so here's an hourly chart on the euro. And you can see how we've worked that bullish order block in here. Working it in bullish order block, fair value gap, sell side liquidity right in here, and sell side liquidity. Right in here we have a little bit of imbalance there with the order block, so I'm going to add that just for observation purposes. So if we look at this, that might be, let me change the color of that. We'll go with this. Okay, so that's the order block on the hourly chart with a fair value gap in the form of a BISI, buy side imbalance, sell side inefficiency, resting right below relative equal lows. Okay, so we did get below it a little bit here, filled in the imbalance there. Do we drop lower with a continuation on the upside on the dollar? And then how we react inside this order block, because remember, look, we have equal lows, the raid, displacement, back down in, the reaccumulate, sends it higher, sell stops taken, rally higher, buy sell liquidity above here, paired up there. And we talked about all this last week in the weekend review. But I want you to take a look at what's showing here. Remember, we didn't want to see the euro and we didn't want to see the cable market break a specific low. If it breaks a specific low, then obviously that gives us a different context and a different bias. But if you look at the consolidation in here, okay, we have consolidation, ramp up, reaccumulation, smart money reversal, low risk sell. There's our institutional order flow entry drill right there. Fair value gap there. Distribution, redistribution, another area redistribution with a fair value gap. Spikes in due to swing, drops down. We have an imbalance here. And just as a reminder, if you haven't seen what I tweeted the last 2 days on my Twitter, surprised with my willingness of one of my sons to study euro. And the only thing that he's doing is what I instructed him to do was just look for where the reactions would occur. Okay, and it's basically like the SIB coming back to a bearish order block or just the rebalance, and to look at what it's going to reach for next, because that's how you're supposed to be starting. If you're a new member or if you're really just practicing, that's all you're doing. You're reading price. It's called tape reading. You want to see where price is and where it's likely to go to. Does it mean it's going to go there and go down? That's not what we're implying here. And it's not your job to do that. You just want to see where it is now and what's it likely to reach for next. Okay, the imbalance here. Yes, we have a break in market structure. Yes, the dollar started climbing higher. So this would be a relatively easy short. Granted, hindsight, I didn't talk about it, but I'm telling you how to go into the charts and annotate your charts, look at it from a hindsight perspective, and glean the useful portions of the fractal that's in play. This is a really nice rebalance and then short. And then here's a small one. We get into the 15-minute time frame in here. And what's nice is my son actually shared where he thought it was going to go up to, and then later on where the reaction levels would be. And we see them actually paying out pretty nice. So I'm very proud of him. Okay, because you all think my children are probably, rock star traders. They have a lack of interest in it. And one of the motivating factors was for me to say, look, you're not getting an inheritance from me unless you prove that you can do this. So it's motivation, yes. Should I have required this much arm twisting? I'll leave that up to you to decide. I'm not here to be judged as a dad, but I just want them to learn it. And now that they have a little bit of motivation, they're inquiring about it more. And one of them is, and it's not Cody, so don't think that it is, but one of my sons has a significant learning disability. And for him to be able to do this just proves that no matter what hardships you have, okay, and again, I know some of you also, they're very cynical. Well, that's not trading, Michael. He's just pointing at certain things. Anybody can do that. No, anybody can't do that consistently. And that's all we're trying to point you to, doing the things that lead to consistency. And then once you can do that consistently, then you can practice engaging with paper trades, not even demo. And then once you get good with that and consistent, then you go into a demo account, and you have to do that for 6 months. Then if you're consistent, then you can consider doing a little bit of a low level live account where you're not reaching in there with a lot of risk. You're not going to be swayed by the ups and downs, fluctuations. And then you'll learn how to work with money and not be mastered by it. You'll master the money itself, not be led by fear and greed. So anyway, I said that and I shared that just to, number one, I'm proud. That's his father, but I'm also doing it to inspire those individuals that would feel like they can't get it, or it seems too difficult. Okay, my sons don't have any real advantage. They still have to learn it just like you do. Just because they have my DNA in them doesn't make them more susceptible to being successful in this than you. There are very good analysts and traders in development in this community. And my children may never even get to that level. They may just look at this and say, well, I just can't do it. They may not like the uncertainty of, not always being right, because that breaks people. It completely ruins them. They think if they have a winning system, they should win all the time or at an unrealistic level of accuracy. And when it doesn't happen, they get angry, they lose control of their money management and their trade frequency, and they blow out. And they kill their account and their potential career as a full-time trader because they don't have discipline. And discipline is only forged by doing the very boring things that don't make money in the beginning for a long time. Just like people when they go to school to be a doctor or a lawyer, you got to do a lot of dry, boring things. But when you get out and you're successful in those fields, you can do very well. But anyway, looking at the price action, you can see we have a consolidation, smart money reversal, and then we have run below these relative equal lows in here. So this is a market maker sell model. You will see them clearly in hindsight, but when I give you points of reference where we don't want to see a specific price low taken out, okay, or a specific price level high taken out, what I'm doing, and then you go back and look at all the examples when I say this, you'll see it's there. The prompting that I'm providing for you is that if we break that, then you need to look at what is unfolding. Then it's a market maker sell model. And if it's breaking a key high and we've been bearish, that means we're creating a market maker buy model. And the way I teach you how to use this information and match it up over here, that's not Wyckoff. That's not the accumulation distribution cycle of the Wyckoff markup theory. Okay, that's not what this is. It just looks like it. It's like a rectangle on my charts, looks like a supply and demand zone. It has nothing to do with it. There's no overlapping of that theology. It doesn't exist. Okay, but there's a specific element that you learn in the core content that how this matches up over here. Okay, and that's the key to differentiating, number one, me and what Wyckoff wrote about, and how mine is much more precise and it's predictable. Whereas if you just look at the markup phase and the markdown phase of Wyckoff, it's so ambiguous, it's so open for interpretation. Whereas I can go in and show you how it always matches up with the other side of the buy curve. This is the buy side of the curve, this is the sell side of the curve, and everything has to match up, which is how you understand that this is an algorithm that delivers it. It's not completely randomness and buying and selling pressure. Okay, not every order is being matched up with $20 billion going long. Well, they got to find 20 billion going short. That is not how these markets work. That's not how it is. That's the lie that they perpetuate. There is a buyer and seller match, but they're not doing it like you think. The holder of risk, okay, the central bank, they can sell or provide liquidity and hold on to risk a lot longer than you can because they're in control of price. But you can't do that. You have to be right or get crushed with your money management and stopped out. Okay, so knowing how the markets are delivered and how markets book is crucial to your development, and also to forget all the things that you've been indoctrinated with nonsense, all the fake stuff. Okay, so here's the 15-minute time frame of the euro dollar. And this is that little segment of price action and rebalancing up here to this level, to the order block. This is what my son had actually annotated, and then he did this one and this one in here. And I'm going to basically go over what I told him because you weren't privy to that conversation, so it would be beneficial to you as well. But I did not talk about where he was pointing in his charts that he sent to me, but I did give him some additional insights after he did his observation and shared with me what he thought was going to happen. And then I waited for it to pan out and covered, like a dad saying I was proud of him. But I'm going to go into now a little bit of the detail I share with him in our private discussion. So it's a little personal, but I'm going to basically take it and put it right to mentorship perspective. You all know what this is. This is a SIBI, sell side imbalance, buy side inefficiency. And it's framed from this candle's low and this candle's high. And consequent encroachment is the midpoint right about in here. To the left of that, you can see the last up 2 closed candles. After running some stops, this is a bearish order block. Both candles together makes a bearish order block. Consequent encroachment, SIBI, and then continuously go forward. You can see what relative equal highs. So what's going to be resting above that? Anyone that was short here or previous, their stop loss is going to be above these relative equal highs. When the price starts to drop down, the natural impulse is for scared money to jam their stop loss on an old high if they're bearish, or under an old low if they're bullish. In this instance, he had pointed to a specific price level where he thought this would be a viable fair value gap. And I want to talk a little bit why this is not something that you would expect or would look for it to be filled after the market has shown a willingness to drop like this. So with that, let's add the lipstick. So you have relative equal highs, runs the stops, and then rejects, breaks down. So we have all of the imbalance here, and then consolidation, so buy side liquidity builds up. 20 pips above would send us about into this level anyway. So the run to this rebalance and buy stops right above these equal highs. Even though there is a fair value gap here, and I'll annotate that a little bit more visually here. Okay, so you have a fair value gap that resides there. This is not a fair value gap that I would expect it to trade up into to go lower, whereas this one is. And I know some of you, again, it's going to be the new people that always does this. Oh, he's only pointing that because it's the obvious one. Okay, no, I'm giving you the logic, because when you see future examples of me talking about it, or when I talk about it in my analysis and why I believe this is what's going to happen, you'll see that this is actually a signature that repeats itself over and over again. I just don't draw a special amount of attention to it, because these are the observations that you're going to find by going through the core content in the lessons I tell you to go through. But anyway, buy side liquidity here, it rallies up, hits the bearish order block, rebalances all of the SIBI, sell side imbalance, buy side inefficiency is back, basically put back in order when it trades back up to here. The high on this candle comes in 1.08873. So this should actually show 088772. Yep, here it is. And this actually goes up into it, the high being 1 pipette above. So it went to it, off by 1 pipette, then the sensitivity comes in. The fact that we rallied above these equal highs and the order flow has changed, we don't look at this stop run here and then once it breaks down, expect it to trade back up above to an area where it's ran stops. That's not what institutional order flow does. So while this may be a fair value gap by visual representation between this candle's low and this candle's high in that one single pass with the candle, it's not a fair value gap because of the logic that's being shared here. The work has already been done. All of the stops that we're residing above these equal highs here, that's been purged by running to the previous order block here and rebalancing the SIBI. Once price breaks down and gets back below rather this relative equal highs, the work has already been done. So why would the market want to go back up to this level just to rebalance that? Can it do it? Yes. Is it likely to? No. Is it more likely to just rebalance an area here or break lower? Yes. And that's what you see here. So he had this area in here highlighted in his next chart, and it went right back up into that, rebalanced. And look at the buys of the candles in here. Okay, let me zoom in a little bit. Now I apologize if my voice sounds a little scratchy, but I do suffer from seasonal allergies, and it is what it is. But we have the bearish order block, up close candle right before the displacement. Displacement is a fast, rapid run in a direction that creates little imbalances right in here. This is a SIBI, sell side imbalance, buy side inefficiency. From the previous candle's low, the bearish order block, which is the last up close candle right here, that little tiny one, that low is 1.0856 and 2 pipettes. Once breaks below that on this candle, this candle's high here, the next up close candle high being at 84.83. From 84.83 to this candle's low, we have a sell side imbalance. It's lacking delivery of buy side. It provides it when it goes back up here. Okay, so for every down move, a symmetrical market will see an equally up move. So it rebalances that. It's not support and resistance. It's not supply and demand zones. Okay, it's the price engines at the central bank that deliver and book price based on this. It has nothing to do with your triangles, your rectangles, your animal pattern, none of that stuff. It has absolutely nothing to do with that. It's the logic that's taking place here. Relative equal highs, rate of stops, breaks down back below. So it's already did its work. It doesn't need to go back above that here. So what is the real imbalance that resides in the marketplace? At this time, it's this one. That's a real fair value gap. And we have what? Relative equal highs. The same thing that's being seen here with this imbalance. And we have equal highs. And it's going to rebalance back to an old area of order flow. Here it is. That same thing. This is fractal. This whole business right here is the same thing this is, just on a very smaller scale. And when I'm looking for entries, or if I'm scaling into something that's larger, this is what I'm looking for. When I'm doing practice sessions, or if I'm, doing any kind of exercises, whatever, this is the things that I'm looking for. It's the same as if you were taking live trades, the same protocol, same process, same mechanisms being applied, but it's nonetheless the same thing. Here we have another relative equal lows. We break down, recreate the imbalance with the displacement, bullish candle, which is the bearish order block, right for the down move. 1, 2 candles, relative equal highs, right? And what does it do? It runs back up into the rebalance of the SIBI, bearish order block, and then displacement again. This whole business here, okay, all of this price action and rebalance back to the bearish order block is the same thing that's occurring here, and it's the same thing that's occurring here. That is all the same fractal. It's the same price model. If that's how you want to trade and you see that pattern over and over and over again in price, that's the one that you should be focusing on. It doesn't mean that you're going to be locked into that the rest of your career and you can't do anything new or branch off of that into something entirely different, or use it as a complementary approach to something else you learn later on. It's the beginning foundation, and that's what every one of you need to be looking for. It doesn't matter if this one isn't the one that you like, but that's one way of using what I teach and say, okay, I understand the concept and I like when it does this, this, and this. And these are some of those elements that come together. How many setups are here? You have 1, you have 2, and you have 3. You have it again too, don't you? Up close candle, displacement, fair value gap. Price runs back up, hits the bearish order block, and then sells off again. So this is a short, this is a short, this is a short, this is a short. And it's all the same pattern of this larger pattern, just seen on a much smaller scale. But it's the same premise, it's the same theology, it's the same elements of my content. I'm not twisting and contorting the vocabulary to make it form fit. But you have to wait until the market tips its hand to you, and it may go against your initial expectations going into the week. It's okay. But once you see it, then you get in sync with the marketplace and practice and engage. And then you'll learn whether or not you'll participate in reversals, because some of you in here will be adversely affected by trying to do that. It'll be hard for you. And then if that's hard for you, don't do it. Just stick with the trades that are in very obvious institutional order flow, directional bias. But reversal patterns take a great deal of, experience. And that's why I have not taught them extensively in the course, because it takes a great deal of experience. None of you have that yet. So I will cover it before I wrap up all the teachings, okay, that I'm going to make available inside this mentorship. It doesn't mean the mentorship ends. It just means the content level of where I'm not going to go beyond, because then it stretches into my personal algorithm and things I'm not going to teach. They only go to my children. And to answer a real quick question I saw before I started the video, no one else has been taught what I'm only going to leave to my children. So that question was asked, and while I'm not going to answer the email personally, but you did get your answer here. So no one has been taught what I know in my head. It's not been made available to anyone else. So don't be feeling like you've been all slighted, because like I told you, there's certain things that I'm not allowed to talk about, and that's in areas where I'm not going to do it. So also, please don't ask me what the two families are. I know I probably inspired a lot of inquiries that I'm not going to answer in email. I'm not going to tell you the name of the two families I was referring to in the last video, but you got to be content with enough. And you guys are getting so much, okay, from the things that I teach you here and the things I'm going to teach you still, that you don't need to know everything. You don't need to know everything. I mean, what I just showed you here, this is enough to do. Anyone with this could go out there and win the Robin's World Cup. It's not an exaggeration. You only need to know what you're looking for. Okay? If you understand this pattern here that I just outlined and mapped out, it's the same pattern that exists here. It's the same pattern that exists here. And it's the same pattern that exists here. It just means that they're all going to yield a different measure of pips based on the overall understanding of where the market's likely to reach and time of day, what day of the week. So it's very encouraging once you can break a market down and look for a specific pattern. And the pattern has to be logical. It can't just be, well, it's harmonic, or it's supply and demand zone with crossing of moving averages and trend lines. All those things are going to make you believe you see something. Whereas if you understand the logic that's being shared here, it's the same thing over and over again. It's displacement, an imbalance. Buy-side liquidity will be engineered here. They'll run it up. Why are they doing that? They want to provide counterparties to short selling with less informed money. So street money gets raided, their buy stops get triggered, floods the market with willing buyers at a higher price, and smart money steps in and sells short in here. The algorithm does not know where the smart money traders are entering. It's not its function. It doesn't do that. It doesn't see your stop. It doesn't see Joe Blow's stop over at Oanda. Okay? It's going back to a logical level where it can remember this specific array. This candle closed up. This candle closed up. This candle closed down. The candle right before this one here closed up, but the prior candle, it closed down. So there's a change in order flow that begins with this candle here. Okay, that candle here, its low is 1.08860. I like to use the big beefy bodied candle. I don't like these little indecisive looking candles. That's the reason why I went with this one, in case you were wondering and wrote down, why didn't he use this one? Even though it's little, it has an up close, so wouldn't the order block start there? By definition, you could use that, and there's nothing wrong with it. You just miss the real precise nature of it. But I like the big beefy body candle to start and end my order blocks. So just like the rejection block, it's like the most highest up close in a swing high. So the rejection block would be 1.08987. That's not a zone. That's not an ambiguous area to choose, well, where do I get in there? How's it useful? You got to figure out, okay, great. And, congratulations, you identified a zone. What are you going to do with it? I'm looking for a specific price level. And that's what the order block, the fair value gap, or the rejection block is going to provide for me. And what I showed you here in regards to the imbalance that resides here. Let me take this box off because now you know what I'm talking about. This little area here is not a fair value gap because it's actually a stop run that's internal range liquidity. So this is just what? A breakaway gap. It's a gap and it's a fair value gap, but it's not a gap that I would expect it to trade up into because it's inside this area here. All of this is the work that's being done by the algorithm. It's not buying and selling that facilitates that move. Okay, the algorithm's going up there to instigate a flooding of orders that would naturally be residing above here, because the quick sudden movement here and high, lower high, but relative equal. Give it time. It sits under there and lets traders go lower with their stop, and then they jam it up here. This is not buying going up here and then smart money is selling it, so they're selling it, makes it go down. That's the most foolish way of interpreting price action I've ever seen, but it's been done, and I used to believe it as a young man in the 20s. I believed that's what was going on, but when you understand what really is going on and what I'm teaching you here, that's the truth of the marketplace. And if it wasn't true, it wouldn't repeat over and over again to the pip. Because what you're saying is the magic of buying and selling pressure goes right to here, and it magically stops right where I teach you where it's likely to stop. Why, if it's just support and resistance, why didn't it stop at this low here? Think about it. There's so many facades that are in this industry that you can waste a lot of time and money and lose a lot of money chasing these things that don't lead to anything but to greater confusion. And I just try to avoid that. So anyway, that's the business on euro. Okay, so here's the British pound. This is our daily chart. And you can see we had nice reaction since running the rejection block in here. Again, as a reminder, this was where I would like to see it draw up to. But you'll learn inside of this swing from here to here, there are specific premium arrays that are targets. And then you'll understand what that is from the PD array matrix and how to use that information. But anyway, the context of the lesson I want to show you today is in continuation of what I was talking about in the dollar index and what leads to the continuation of a theory or a bias or the abandonment of it. So what negates or invalidates your trade idea is important. It needs to be very well defined. And if it's not well defined, then you're not going to know when to pull the plug on your trade idea, preserve a stop from taking a full stop out, or potentially taking a reversal in the marketplace. Not all the time. And again, it's very important that you do not get lulled into thinking or enticed by my talking about it, that every instance of an initial trade idea failing results into an obvious reversal and go the other direction. Because that's not what I'm implying here. I'm not in any capacity trying to sell that narrative that it's true to, if your initial buy is a failure, then go short. Because again, I did that stuff in the 90s and I lost lots and lots of money. I threw good money after bad decision making. And it's just because I was trying to capture what I thought I was going to make in my initial trade, but it ran against me. So I'd either be getting stopped out or I would collapse the trade in a loss, not always in a losing position. Sometimes I would get out before, but the idea or art form that comes into play is a learned skill. So when I teach by weekly reviews and midweek review and weekend review, those two videos, I am co-signing my personal opinion on what I believe the market's going to do. I don't give you plan A, plan B, but I do give you, when it's salient to the discussion, what would negate or invalidate my analysis. Now, it doesn't mean, again, to go in there and when you see my initial idea about what I believe the market's going to do, if it fails, it doesn't mean go in there and go the other way. Because I know there's people in here that have been doing that, and I only hear when it works for them. But I also know that these same people are probably doing the same thing in other instances, and I'm waiting. Sometimes I've had conversations with my wife. I'll say, look, watch this guy. He's going to send me an email and say, I reversed it right here where you said the trade would be wrong. I went in and went short there. And I never reply to these people, okay? They are students that are just doing the same mistakes that I made as an early developing trader where I felt like I had to be right. And I'm going to tell you the reasons why I was doing that. I had built up in my mind what I was going to make on this particular initial trade. and I figured out how much I was going to make and what I was willing to lose. And if it starts paying out, I'm going to make that money. I'm going to take it home and close it in my account. But the account wouldn't see that trade be profitable. It would start to reverse on me. And one of two things would happen. It would stop me out, or very early on when I was afraid to use a stop loss, it would be running against me, and I would be confused as to what I wanted to do. Do I bail out, or do I wait for it to come back the other direction? Maybe this was just a big squeeze on me, and I just got to weather it. And if you've done any kind of live trading, you know exactly what I just talked about. It's a real thing. That's why you have to use a stop loss. That way it doesn't give you the opportunity to get the deer in headlight syndrome where you're not sure what you want to do. And the whole time the market's going to be screaming against you, bigger losses, bigger losses, bigger losses. And if you're on the wrong side of the marketplace and it's a fast move, you're dead. You're absolutely dead. So you have to use hard stops. You have to know what makes your trade invalid. Okay, so if you're bullish or bearish, whatever that initial assumption is on your part, that decision that you've made, it needs to be defined with a line in the sand saying, okay, this trade is viable up until this context, okay, or this change in underlying context where the narrative would otherwise be obviously going the other direction. And I gave you that level for cable. And again, I'm not saying look how smart I am. I want you to take the education and the experience from what I'm going to show you here. That is what you're supposed to be doing going forward. So it's not about me right or wrong. It's not about me being 100%, 90%. That's not my goal. My goal is for you to learn what you do in instances where it isn't panning out. Sometimes you're going to get in there and you're going to feel very, very solid about your assumptions about where you think the market's going to go. It may be in concert with what I believe, and other times it may not be. But at some point in your future, you're going to be looking at these charts without my involvement. And you want to know what you're going to do and what you're not going to do with a rule-based theory, and not just off the cuff thinking from an emotional standpoint. Because if you're going to be making financial decisions from an emotional standpoint, you might as well just prepare yourself to lose a lot of money and be miserable the rest of your life while you're doing this. And you don't want to be doing that, and you can avoid doing it by doing what I'm going to show you here. All right, so anyway, British pound, we do have a sell side liquidity pool here. We're overall consolidating, but I'm going to show you the sell side liquidity pool that exists that may be attacked if we get a continuation higher on the dollar. So we're looking for the low here at 122.47. And the close is 122.97. So that's your rejection block, the lowest down close. Okay, so I'm not going to put that level there. Just be mindful on your own charts. Do that. If we do break lower, I will revisit that price level, and it will exist in the chart at that time. But for right now, this is where we're looking at. Again, it's best case scenario, but we have to measure all of the discount arrays that would exist in this low. From this high to where we're going, we're trading inside the range from this high to this low. So the discount arrays would exist inside of this down close candle and just below it in the form of an old low. Let's go into the hourly chart. Okay, so here is the hourly cable chart, and you can see the levels and the kill zones that I annotated on our previous discussion. And the market has since broke down. And we did not want to see it trade below this low in here. We already seen these lows taken. It rallied through it, broken to higher market structure break, all of the accumulation in here, rebalancing as I mentioned, and we rallied. We went above the rejection block on the daily chart, but we didn't get above the old high. That's what was failed here. Fair value gap here. Market structure is broken. Here, rebalance. Consolidation, breaks lower. We have a fair value gap here. Price runs up into it. Goes a little bit higher, but it's inside the bullish candle still, which is a what? Bearish order block. So it trades into the bearish order block, coupled with a fair value gap, breaks down. we have another key low here. If this is broken there, then you know that you're looking at what? What is this pattern here? Market maker sell model. And you pair it up with the order flow on this side. So the market breaks down, creates a fair value gap, price runs up, buy side liquidity, relative equal highs, consequent encroachment over here, same order flow, just in reverse. Here, trades down. There's a sell, small little imbalance in here, trades into it here. Then we consolidate, get sloppy, breaks hard, runs the sell side liquidity in here, small little imbalance in here, you see it trading there, and then we have obvious sell side liquidity resting below these equal lows, and we're just going to take that line here and just use it, keep everything clean. So that's our next sell side liquidity. On the downside, near term, it's 23 big figure. It's about 45 pips or so, and we should see that spread down into that tonight if we see the bullishness on dollar. Don't believe we need to go up to this level here to break lower, okay? Because to do that, that would just be like, okay, here's the old low, broken, now turn what? Resistance. We've already done that here, okay? This low has been tapped. So the whole resistance and support theory, or support broken, now turn resistance, we've already seen that narrative underway. Okay, so if it goes back up in here, it may need to trade to consequent encroachment up here, and then it becomes an iffy thing for non-farm payroll. From where it is right now, my opinion would be it'd be better just to deliver it to that 23 big figure and just below it from where we are. Now, by the time we get this video online, it could do that, even the time of day it is right now, going into 3 o'clock Eastern time, because right now it's 2:54 in the States on the East Coast. So that's what I would expect it to see. We don't really see anything smooth up here that would be, noteworthy to see it come back up there to go lower first. So the overall structure is in play that we would expect lower prices to be delivered from where we are and not see a rally up. So if it rallies up in here, then it sets the stage for maybe a non-farm payroll plot twist. Then they'll run these highs here and mess around with the dollar in terms of its bearishness and revisit that narrative. Okay, so here's a 15-minute time frame on the British pound, and you can see we had multiple attempts to get up into institutional order flow entry drill. We had 1, 2, 3, 4 times it went above inside of this SIBI before we had displacement, and we're consolidating. So you remember the economic calendar, what's coming tonight, and we'll see what happens. Now, if we have a real wild reaction in price, like if it stays inside this small little consolidation, it could create 2 scenarios, okay? And again, these are just a study. I'm not trying to say which one I'm going to be right about, but just monitor the willingness to get down into this level here. So if we drop down into that, into the news or those news releases, then we could see it reject and go up here and rebalance there. Or if it runs up into this area here, then I would look for it to trade down into that level there. So those are the 2 scenarios that I would look to practice reading price should it do either one of them. At this moment, because of the nature of the economic calendar and it's the weekly profile that we avoid, we don't trade the Thursday or the non-farm payroll Friday of non-farm payroll week. Our trading is usually done by Wednesday, New York open. No new positions are opened. None. So if you haven't had a trade on Monday and Tuesday, and by Wednesday's New York open, we do not take new trades. We can manage existing trades, but 80% of the positions should be squared, stops should be tightened, and just prepare to be stopped out. And if it can run in your favor, great. But it has nothing to do with skill, because the uncertainty factor is so high on these 2 days of every single month that it's foolish to attribute it to skill. Okay, period. End of story. All right, so the last bit of business, we're looking at the E-mini S&P. This is a daily chart on the June contract. So if you were looking at price to trade, the actual S&P index, this is the chart that is the most active right now and will be considered nearby or front month. The volume imbalance in here that I drew your attention to Okay, and what we're showing is the bodies, okay, in the absence of any candle body in between these two particular candles. And we see the really nice delivery here, and then we expect it to trade lower, and it trades lower. Let's go into let's just go right into a 15-minute time frame, save a lot of time and get right to the good stuff. Okay, so we have consolidation, breaks higher, reaccumulation, reaccumulation, multiple levels of reaccumulation until we trade into the volume imbalance. We get a break in market structure here. So now we can start trading what? Every SIBI rebalancing or back to a bearish order block or running of buy side liquidity. And there's multiple instances of that here. Sell side imbalance here, fair value gap, trades up into bullish candle, which is a bearish order block. Let me open this up a little bit more so you can see it. And make it a little bit higher. All right, so we have original consolidation, reaccumulation, smart money reversal, low risk sell, redistribution, multiple levels of redistribution here. Again, that match up with the buy side of the curve. We have an imbalance here, trades back up into that. Buy stops, bearish order block. There's that same fractal I showed you on the previous discussion where it repeated itself multiple times and then it sells off. This low, did it go below these relative equal lows? No. It creates a real gap. Price trades up, closes in the gap. That's a fill for a short and look for it to trade lower. It stops here, consolidates. So what is it doing? It's crouching here and here right below these lows is liquidity, and you have this one so close in proximity. So if I have this and then something like here like as an outlier, the idea would be to run that next. Okay, and it's really not on that low. My OCD's flaring. The sell side liquidity resting below these lows here is still untapped at this point, and then we create a little bit of a retracement and then dive quickly for it. Then we rebalance back to the bearish order block here, and then displacement again. Fair value gap, relative equal highs, which is what buy side liquidity resting here, and then smash it down on the opening of the new week. Create a opening gap, trades up, fills the gap, goes lower, comes back up, and now watch what happens. In here, there's your gap. The opening price, that's what you want. That's your real gap. So where we closed on Friday, where we open on the next candle in a new week, that's your opening week gap. The price trades up, doesn't completely fill it here, trades lower. So now look what's going on. We have buy side offered, sell side offered. So to this point here and this point here, the range is rebalanced. Okay, we have the market trade lower again. Its sensitivity is off that opening price here, fills the gap entirely, and then comes back down to what? Midpoint or consequent encroachment of the gap. Bullish order block, sell side liquidity, starts a rally. Now you can start looking at every down close candle support price, every BISI, buy side imbalance, sell side inefficiency, or up close candle that's surrounded by a lower high and a higher low candle, which again is just simply a fair value gap. Trades down into it, order block, fair value gap, buy, relative equal highs, buy side liquidity, imbalance. Price runs up into it, consolidates, fair value gap again, rallies back to what? Old order flow. And now we have buy side liquidity resting above these relative equal highs. So this run here closes a fair value gap, bullish order block here. And we have a small little area in here that creates a volume imbalance. Again, we have the filling of this gap a little bit, but we still have the bodies of the candle only to here. Well, not there, right there. Okay, so that's a volume imbalance and a natural gap, a real gap. Okay, so we can look for 2882 to be traded to, and it hits it. Boom. Once it hits that, look what the sensitivity is. Look at that. So this whole reaction here is the same thing that I outlined with this volume imbalance on the daily chart, only being shown here. Once it fills in this volume imbalance, yes, it goes above a little bit. Yes, it goes above a little bit. But the context is we've balanced a volume imbalance that would otherwise be nothing spoken of it. There's not talked about in any other theory. No other educator, no other trader, no other mentor, no other nothing has a volume imbalance. Just me. And you're learning that signature here. Look how pretty the trend line would have been. You draw all the lows together. See that? That's your trend line phantom. And the logic is that it should be met with selling. The repricing should go lower. And we see that happen here. And then returns right back to what? The volume imbalance again. Sensitivity, bearish order block, SIBI, hits it, and then what? Runs lower. And that's a trade. All of this is the same thing that we were talking about earlier in the video with the same underlying premise. Relative equal highs, SIBI, bearish order block, boom, hits it. Couple it with a volume imbalance. You're just adding one more measure of confluence of PD arrays that you learn in the mentorship. And all of these work out to be trades. And this is a 15-minute time frame, so you could look at 1 minute and 5 minute charts all day long within all these levels and get multiple swings, many swings over and over again using a very, very small, ultra short time frame like 1 and 5 minute charts. Again, it may not be your cup of tea, it may not be your thing of choice, but just know that they are opportunities for you to practice a lot, even in hindsight. So that is going to be it. We're going to see what happens overnight in London with the cable and the news that's going to inject the volatility. And then we'll see what we see on non-farm payroll Friday. Until I'll talk to you on the weekend review, wish you good luck, good trading, and be safe.